Hello, friends, and welcome. Welcome back to another session of High Five. This is Michael Long back with you with the CFP staff faculty. I hope your studies are coming along nicely, and at this point you have gotten into a pretty good routine and have looked at the 10-week study planner and are following it just as closely as possible to the letter, preferably, as I've mentioned before. That's the number one common characteristic we see every year, every exam cycle. Those who end up passing the exam are the ones that stayed pretty much letter for letter to the 10-week study planner. If you have any questions about that, always submit them through your instructor link service or even to me directly at michael.long@kaplan.com. And as I've mentioned in other sessions, same goes with any questions that this session might create for you. Send those to me directly. If you happen to use the instructor link, just make sure you put high five in the subject line so they know to route it directly to me. But I'll be happy to help you with any clarification or more detail that we might need from today's session. So we're going to move along today. And again, the journey is crossing that bridge from understanding the academics of a given topic to using that knowledge, that academic knowledge, and applying it in a financial planning scenario. Nearly all of your questions on the national exam will be some element of application. Now, I think I probably have said this before as well. Often, the application that's required it's pretty basic. It's not 10 layers deep, as I like to say, in the intricacies of a lot of these topics. They just really expect us to know how to apply the most important features of these respective topics. So if you start to have that mindset, you're well on the path to crossing this bridge. It has a steep climb in the beginning, but you'll pick up momentum and race to the finish line. So that's what this is all about. As I always say at the top of these sessions aren't per se academic teaching sessions. It's more focused on using some given academics and then focusing on unique aspects of the academics that make for great exam questions, and also to pass along some tips and tricks you might be able to use to remember some things. And some examples of what to expect in the question pool. There are some things that have been around a long time and tend to show up more often than not, and I'd like to share just some insight with that kind of thing as well. And then my reminder, whatever week you're in your study plan, have you read the standards of professional conduct at least once this week? If you haven't had a chance to get into the replay for that session, I did a special session just about the standards of professional conduct. It's available to you on demand on the dashboard, but it's really important for the national exam. There'll be some test questions that come right out of that material, but it also is a great source, the best source to pick up CFP Board's perspective of what happens, what should happen in each of the steps of the financial planning process. So give that a look. If you haven't already, or if you haven't have questions, please send them. But today, it's all about Book 3, investment planning. A lot of you have very serious experience with this, but I want you to stay tuned in because I want you to max out your points in the investment section. If this is your strongest suit, and this applies to really all 6 core topics, if this is your best topic, make sure you study it just as comprehensively and diligently as you would any other topic. And there's a good reason for that. Right now, you may be sitting with expertise and understanding of investments that you could walk into that exam and easily get 70% of the possible points without even looking at this. That's good, yeah? But because you speak the language so well and you absorb this information easier than, say, someone with a different specialty, you're able to pick up the nuances and the little wrinkles that they might put in an investment term or topic. So if you study that, you could then walk into that exam and perhaps get 90% of the total points, maybe even 100% of the total points for a given section. So you might need that. If you stub your toe on one of your weaker areas, maybe by maxing out your points in your strength areas, you can make up the difference and still be over the pass line. So don't let up if this happens to be one of your stronger areas. And also the disclaimer I do with each session, please, please, please don't think that the topics that I've selected to discuss today are the only investment topics that you will see tested. Anything on the list of 72 topics is fair game. What I've chosen today, in the interest of time primarily, are some things that tend to show up and how they tend to be tested. But that doesn't mean this is a replacement for reading the books. You really need to read the books cover to cover, work every question that's embedded in the sections of the book and the domain questions in the back. That's how you're able to max out your points in any one of these six books. Okay, so we're into book 3. The first thing I'm going to spend a considerable time on today is looking at the provided investment formula page. This is how it currently appears at cfp.net as the under publications and resources. If you want to go down there and get on there and download it, this is how it looks, and this is how it looked in the last administration of the exam. So one of the things we need to do is be able to recognize these by sight. So as part of your normal study routine, I would print a blank one that's not labeled and see if you can label them as you get deeper into your study plan. Can you just look at that sheet and say, okay, I know what this one is, this one, this one, this one, this one, because you're going to need to do that for the exam. But I also want you to check back on this at cfp.net, and certainly we would post anything new as soon as we see it. But the last couple of cycles, CFP board has been a little notorious for changing this sheet, not for purposes of stumping you or making it more confusing. It seems to me that they keep arranging things. They've added several formulas in the last year or so, and they seem to be playing with the space, the layout space. And just check back as you progress closer and closer to the exam to make sure that they haven't posted a new formula page. It's going to be the same formulas. It's just where do they fall in the order of the page. But then also in your book, see right now they've got this down to 1 page. Recently it's spilled onto 2 pages, and this looks like an attempt to get it all onto 1 page, which is great. That's fine. This works. But for what I'm going to cover today, it really crunched the space I had to work in and give you some notes and tips and shortcuts and things. So I'm going to work off of one that still goes on to 2 pages, but it'll be all the same formulas. If you need to print one that's labeled to study first and then do the practice routine of labeling it yourself, there is one in your appendix for book 3. And it's easy to find, and this is a good starting point just to keep them labeled for a while and then start testing yourself on the order. If you need help with what the various symbols mean, particularly the Greek symbols, there also is a nice key for you in the appendix following the sheet I just covered. It's just behind that. So you can print this out too if you're still learning what some of the different symbols mean in those formulas. I think this one goes on to 2 pages. Yeah. All right, so that's a starting point, but what I want to do, this is actually the last version before they took away all the space. And I thought I could do a better job of giving these insights and tips by using the larger spacing. So that's what I want to do, is just go through these one by one, talk about probability of being tested or frequency that it seems to have appeared in the ones that seem to almost always appear. You won't do all of these formulas, so don't worry about that. You're not going to have this many questions, and it could run from a few to where it felt like, yeah, I did use quite a bit of that page. But I want these to be gimmies for you, and if you spend some time and deliberately practice it, I think you can get to where these become easy points. So I'm going to go down the left side first, and then we'll come back and go down the right side. So the first one is very easy. You probably remember this from your required education course, the constant growth dividend discount model. This one's an easy one to spot. Very few variables. We would be given a dividend amount, a current amount. We would be given an anticipated growth rate and a required return. Drop them in and we're done. The biggest mistake that is made with this formula is we forget to advance the dividend, the numerator in this equation. We forget to advance it one period. So if there currently is a $2 dividend, and in the question narrative it says they expect the dividend to grow by 10% a year, we would need to use $2.20 as the numerator in this fraction. Other than that, it's really easy. There's a very good example in the book on pages 122 and 123 that you can take a look at. The other way that this one gets tested sometimes is not to do the math, but what would you be looking for? What kind of company would be best suited to use this valuation model? And what we would be looking for in a correct answer would be an established company with a history of dividend payment that make it more predictable, rather than, let's say, one of the answer choices would be a startup company. We're looking for that more mature, established company. That's the second way this one's been tested. I don't get much feedback about the second one, expected return form of a dividend discount model. That one, again, you're just reworking the numbers from the first one. So it's an easy one if you happen to spot it. But just this would be an RTFQ, read the full question piece. And what are they asking for? Are they asking you to do the valuation? Or have they flipped it and said, we want to know the return that's in this calculation? Also, I want to back up my note on the right side of the first one. Be prepared to do a multi-stage variable growth dividend discount model. That has shown up in the past. Frankly, I don't hear about it as much as I used to when there were more questions on the exam, but be ready for this one simply because it's not given. There's not a provided formula for multi-stage. And what that multi-stage means, if you remember, is just that there is an assumed change in the dividend growth rate along the way, maybe 5 years at 5%, and then 5 more for 10 years or what have you. They could change it. They usually don't change it more than a couple times, so be prepared for that. And that's what the good example's about on 122 and 123. I mean, in that same section is the constant dividend, but the 122, 123 references for that multi-stage. So get ready for that. Covariance, again, if there is a question in the pool, it's probably just one. And it's another easy one with very few variables to spot. So you're looking for the correlation coefficient, and you're looking for the 2 standard deviation amounts from the 2 portfolios or 2 assets. Then just drop them in. Now, I've stopped here too on the Greek symbol rho for the correlation. That one's an important one because we quite often have to come up with the coefficient of determination, which we all know to be rho squared or r squared. You might have to calculate that, no big deal, but probably more likely you would then use that to determine whether you're going to go with Sharpe or trainer ratio, because we have to have a pretty significant R2 to trust beta as the risk factor, which would make us lean to Sharpe if we don't have a high value. Now, you've read about that. You probably remember that now as I bring it up. It won't be close, though, because folks will often write and say, well, what are we looking for in the R2? Are we looking for 70? Are we looking for 80, 90? What is considered high enough? It won't be close. If they're testing you in this manner and you have to pick, that R2 value is either going to be really low, maybe it's 30, or it'll be high, 80, 75, 80, and it'll be easy to spot. They're not going to make that value be 69. They just don't do that. But be ready for it, because quite often you'll have an exam where you have all the data to do both Sharpe and trainer, and then you have to make a decision about that, and this is where you're going to look, is what is that R2 value. Then standard deviation of a 2-asset portfolio, kind of the mother of all calculations here on this sheet. This is one of those that almost always showed up, sometimes more than once. Not so much anymore, but if you will practice this and realize that the variables are pretty easy to spot and drop in, this one too can become a gimme. It takes a little bit longer to do longhand, like you'll have to do it on your calculator, but it's not complex if you know where to drop the different variables here. There's a good example of this on page 72 of your book. Give it a look. It's just that after the exam, a lot of my students will say, yeah, I guessed on that one. I didn't want to take the time. And I suppose that happens a fair amount, but it really isn't hard if you'll just practice it. So give it a look. The biggest mistake on this one that I've seen is we forget at the end, after we've dropped all of those values in, we forget to take the square root of it all at the very end. So just be cognizant of that as you practice, that after you do it all, we're going to go to square root. Beta, I don't know if you'll have to calculate beta. Usually it's really just a given. But here again, if you know the makeup of covariance, we're just going to square the standard deviation in the denominator, and there you go. And you've got, you know what rho stands for and the R value, so you can drop them in. But my guess is this will be a given for you. Now, occasionally, you have to do a weighted beta for a portfolio. And with all of these calculations, same would be true if we have to do standard deviation. It's never a long sequence of values. It won't be, if you're required to calculate a weighted beta, it's not going to be 15 assets in the portfolio. There's just not time for that, and they recognize it. It would be a handful that you would quickly apply a weighted beta calculation, which you can see on page 66 in book 3. Now, if you just came out of the Capstone Financial Plan Development course, I think most recently there's been some an element in those plans where you had to do a weighted beta. So this one should be very easy for those of you who just did your 107 course. The next two standard deviation calculations, you will not use these longhand unless you really are a math expert, which I'm not. You know, you might enjoy that challenge if you're really into math. Most of us aren't, and you won't use either of these then because they have shortcuts. Now, and the difference here is just with the population model on top, it means we have all of the outcomes to evaluate. The more realistic one would be the next one, where it's a sampling. We have a sampling of historical returns, and that's what we're going to evaluate for standard deviation. However, the good news is really good shortcut for standard deviation of historical returns. You can see that shortcut on page 69 in the book, as well as your calculator book. A lot of these calculations you could also find in the calculator book, Understanding Your Financial Calculator, Kaplan's book. And there are practice questions. If you feel rusty or out of touch with the financial calculator, you really need to have that calculator book, because it has keystroke instruction for multiple calculators for nearly every calculation you might need to do for the national exam. And there's a couple hundred practice questions on calculations, so don't forget about that. Also, along the lines of standard deviation, you could see a question with what we refer to as the area under the curve. It's still standard deviation, but rather than calculating a specific number, they ask us to calculate the probability of a certain return, and they will give us the mean return, and they'll give us the standard deviation, and we take it for there. I created an extra page following this one that I'm going to get into that area under the curve, but be ready for that, and you can read about it on pages 67 to 69. So I'll do that just momentarily. The last one on this page is CAPM, another really easy one. And you're looking, you can start to spot and anticipate what the last sentence of the question is going to be and what they're asking you just by spotting what variables they're giving you. So this one, what I boxed there in green is just simply one mistake that we do see on CAPM is when the question has used the reference the market premium. And what that means is that math is already done in the parentheses. They've already done the market return minus the risk-free rate. That's done, and they just give us a number. It doesn't need to have any other calculation for the work in the parentheses. We'll see the mistake being made where they told us the market premium was 10%, risk-free rate was 2, and the student will take the 2 from the 10 and use 8 in that market premium section. So an easy one to fix, just again be alert. So down the right hand side, I think you'll have at least one question in involving Jensen's alpha. And again, it should look familiar if you look at the CAPM calculation down here at the bottom. Look at that in the brackets. Essentially, we've got CAPM going there, don't we? So this could be a twofer if you get it correct in the CAPM piece. Now, one of the exam questions that still is in the pool is a question not having a calculation, but rather which of the following measurements is an absolute measurement? And it's just Jensen. Sharp and Trainer are both relative measurements used to compare. Jensen is the lone alpha in that group. Very easy, correct answer. And see, that's what I hope happens with this high five stuff, that along the way with these conversations, you pick up one more correct answer, 2 more correct answers that eventually get you over the bar. I have always maintained for all of these years that those of us that passed that exam probably didn't blow it away. We probably didn't pass with a really huge margin. And likewise, those who don't pass the exam and studied and diligently studied, if they didn't pass, they probably didn't fail by much. So one question here, one question there can make a difference, and that's one of the hopes I have for high five discussion. So you've got the absolute measurement with Jensen. Below that is Trainer, and you probably remember now that Trainer and Sharp are very similar. The difference is what's used in the denominator as the risk element, and in Trainer we are using beta, and in Sharp, which I think comes up a little later, we use standard deviation. And I normally on this page have a note when we get down to Sharp. The way I've always remembered that, which one do I use Sharp, which one do I use, is that the S in Sharp to me always stood for standard deviation. Because you could just get a question about that, not doing math again, where you can look at the formula and know that T is Trainer and S is Sharp. If it's a conceptual question, then I remembered S in Sharp is standard deviation. Macaulay duration, that calculation's easy if you really look at that. It's repeating the variables, but there's a short list of variables in this one. Again, if you like math, you'd probably do it that way, and you can do it pretty quickly. However, most of us are going to use the shortcut, and that's on page 112 and 113 in your book 3. The next one usually does come up in the exam as well, or it's absolutely in the pool, and that is where we're asked to estimate the change in the price of a bond, the market value of a bond, using duration. Again, really short equation. The biggest mistake that is made is we forget to put the negative sign in front of the duration figure. But as an aside on that, as I'm sure you know, we can narrow usually 2 of the answer choices on this kind of question because of the fact that we know that bond prices tend to work in the opposite direction of changes in market rates. So usually on these kind of questions, two of the answer choices are going to be positive and two of them are going to be negative. So immediately we get rid of two of them and up our chances if we really are not too familiar with this particular piece of a question. Information ratio, they added that a few years ago. Never heard of it being tested. It is in the book, though. All of these things are in the book. If you need to review, how they work and what it's about, that one. And then effective annual return is also a newer one, but it's never one that's been overly challenging. But they would need to use the word effective annual rate in in that kind of question stem to keep you on track. So we could just drop that one in. Same with taxable equivalent yield. They would need to use that wording, and we could go spot this one. Arithmetic mean is the easiest calculation probably of all. Adding up the returns and dividing by the number. Here we go. They move sharp down here. And again, the big difference here is Sharp uses standard deviation, and you know from your courses that standard deviation represents total risk. So my thing has always been, if you really don't know, if you can't tell which one to go for in the question, my general rule has always been, when in doubt, be sharp, because of the standard deviation factor that we're considering all risk in standard deviation. All right, unbiased expectations theory. I don't think ever we will see the requirement to do that calculation. It's relatively new to the formula sheet, but the testing on it has been just conceptual. What is it for? What's it mean? And it's basically based on the theory that you can use long-term rates to predict future short-term rates. If you haven't read about that yet, it's right there on page 109 in book 3. So just know that theory piece. Holding period return, I mean, that one looks more complicated than it is. If you we use the shortcut on page 75, holding period return becomes a very easy calculation as well. So I hope you picked up some notes there. Don't be intimidated by that formula sheet. You'll get it. But like anything with this CFP business, you keep working at something and it eventually clicks for you, just like the calculator. But if it's been a while, don't forget about that financial calculator book, because it just shows you all the input. If you still don't connect with it, that's a good time to send it to me and I'll help you out. Just, if you do that, send me your input though, okay? So I can maybe spot very quickly what your error is. Now, this is something that you would have visited, net present value and internal rate of return. You would have worked with this way back in 101. And the examples here are actually from course 101, but it's revisited, and NPV and internal rate of return are revisited on pages 78 and 79 of book 1. I think super high probability you'll have at least one of these, maybe both of them. You may have to do both of them in different scenarios. But I also like to include this one in high 5 because it gets us another opportunity to talk about uneven cash flows method on the calculator. That is one, if it's been a long time since you've had your calculator out, you might be rusty on uneven cash flows, but I would love for you to give it a chance, to spend some time with it, study with it, because it can save you time on the national exam. This one's easy, but what I'm talking about in saving time is for an education funding calculation, particularly if there's 2 children involved. If you have to do both of the children, if they're different ages, and run separate calculations under I think some of the instructors call it the 3-part trip, that's really time consuming, and you can knock it out much faster if you know uneven cash flows. And that's what NPV and IRR are about. So just conceptually, what are we talking about with NPV? The right-hand box there equals the difference of the initial outflow, that initial investment, and the present value of the discounted cash flow. So they will give you that required return in this kind of calculation. That's all it represents. And NPV is easy to remember what we're looking for. We need a positive value. If NPV is positive, then that means the present value of those future cash flows discounted by the client's required rate is greater than the initial investment. We're just looking, we need positive value. Because the way this gets tested is, it usually is the purchase of a piece of machinery for a business. And they are contemplating this, they give you the cost of the machine, they tell you what the anticipated cash flows to be generated. Would you advise that they invest in this? So again, you can anticipate what the end of the question is going to ask you to do by what variables they're giving you. Over here in the right-hand box, you see the income or interest per year input will be stated as the client's required return. If you're going to get an internal rate of return question, they're not going to give you that value. So you can spot that right away. And then I like the summary box there back on the right side. If NPV is greater than 0, then the internal rate of return is going to be greater than the client's required rate of return. If it's 0, if net present value is 0, it means the internal rate of return is equal to the required rate of return. And we would probably recommend the investment in that case, because they're at least meeting their required return. And if NPV is less than 0, then the internal rate of return on that investment is going to be less than the required rate of return, and we would say, no, you should pass on this one. I put that in there simply because that is one of the ways that gets tested. No math involved, just conceptually, what does it mean? What does it mean if the net present value is less than 0? So there's another correct answer for you. And then the sister calculation is the internal rate of return. Here again, if you notice in the facts, it's not telling us anything in this one, so we need to solve for that. We knew from the data from the previous one that we had 10, but here we're solving for the internal rate of return, and it comes up 11, which is greater than the 10 that was what was required. So pretty easy to spot these, and again, I think you probably end up doing both of these on the exam. It will just be a different story attached to it rather than one example like this one was. Okay, now I want to get into standard deviation. Talked about those couple of formulas that you'll use shortcuts for, but there are numerous questions that can revolve around standard deviation, just in the formulas alone. We might have to, on the exam, calculate standard deviation from a short list of returns, from a short list of outcomes. We might need to do that. We might need to conceptually understand, what is this representing? Those are things I want to talk about next. So this area under the curve, I put the color boxes on this. We get numerous questions on this. I think it's easy to get confused in looking at these bell curves. And this is the one where we're going to be asked, what's the probability of the client achieving X number return? So from the books, you can see that right in the middle of that bell is the mean return. It's rare that you would have to first calculate that and then drop it in. If they're going to test this bell curve, you're probably going to be given the mean return. And what we've learned from this in standard deviation is that 68% of all outcomes, of all returns, are going to fall within one standard deviation up or down of the mean return. And that's the part some folks struggle with, is realizing that one standard deviation might mean a return higher And then we go the other way to the left where it's lower than the mean. And then the numbers jump dramatically. 95% of all outcomes will fall within 2 standard deviations of the mean, and 99% of all outcomes will fall within 3 standard deviations. So we can work with that. There's an example that I'm going to lay out in the extra page that I came up with. But the example is just that the mean return is 18%, and the standard deviation is 6%. So what that means is 68% of all outcomes are going to fall between 12%, which is on the left side, and 24%, 1 standard deviation on the right side, 18 plus 6. So that's all we're doing is plus or minus. 95% is going to fall between 6%, which is 2 standard deviations, and 30%, and then 99% are going to fall between 0 and 36%. Now understand too that the bell is divided right down the middle, to the left of the mean and to the right to the mean. So what that means is that you divide those 3 values, 68, 95, 99, divide them in half. So 34% of the outcomes will be above the mean, and 34% will be below the mean. In total, it's 68% within 1 standard deviation, left or right, up or down. So that's another common mistake, is we forget that split down the middle, 47.5% on each side and within 2 standard deviations, and 49.5 within 3 each way. And that's how you can use the information in the examples. You can come back to this. I'm going to come back to this and talk about z-score in a moment, because there's a question in the pool about z-score. But what I wanted to get to is this area under the curve, since we're on that. So I just have blown up that bell curve and put some notes in here. So you see our bands again, and the mention up top there that 50% of all the returns here are going to be above 18%, and 50% will be below. And the breakdown again. So here's how the questions come. It could be something like, what's the probability a return will be above or below 18%? That's the easiest one of all, because we already know 50-50. But what if the question is, what's the probability of a return will be above 30%? That's a little harder. We got to think for a minute. So 30% is what? That's 2 standard deviations. So what does that tell us? Well, that tells us if we know that 47.5% of all the returns are going to be between 18% and 30%, all that's left to go above that is the rest of that 50% from the right side above the mean. So that's a simple one, just to subtract 47.5 out to that 2nd standard deviation from the 50. We have a 2.5% probability. Now, in the book, there's another way, and which one makes most sense to you is the way to do it. Another way to look at that one is, well, let's see. We know that 2 standard deviations up or down is going to account for 95% of all the returns. So we're starting with 100%, right? That would be everything. And if 95 of it's covered either up or down in 2 standard deviations, that leaves just 5%. And since we're talking about a positive number, we're going to the right, so we divide the 5%. Same answer, 2.5% probability. So I laid out this one. This is the one that I've always used, where I just break it down into the right and left sides. The author of the book likes the sum total. So whichever one makes sense to you, use that. So the same kind of question, going to the left side below the mean, what's the probability a return will be below 12%? Okay, so we locate the 12, and that's 1 standard deviation. Again, to the left side of the mean, it's 50% of all returns. We know that 68% are going to be within one standard deviation left or right, so 34% go each way. So here I'm subtracting the 34% from the 50. We have a 16% probability. The other way to look at that one, like the book would, is 100% minus the 68 one standard deviation. That leaves us with 32. Divide it in half, we've got 16% probability. And then I just laid out what they show in the book. I like them both. I just studied with the one going left and right. And I literally, in practicing this, and I did it, I had more than one of these on my exam a long time ago, but there were a lot more questions. So I literally on my scratch pad would draw the bell, and I would put hash marks in the middle for the mean return, and then 3 to the right, 3 to the left, and immediately put in the numbers. And then I could do the probabilities, and after a while you get pretty fast with that. So again, I'm hoping this one could become, oh good, here's a under the curve question. I'm going to get that right. This z-score stuff hasn't been in the exam a long time, but it is showing up now, and it's a really simple one. The definition there is just that the z-score measures the number of standard deviations a return, or they call it data value, is from the mean, whether it's up or down. So, all we're doing here is subtracting the mean value that's given from the return they're telling us about, and then divide it by standard deviation. So the example I have here is from that previous example where we had an 18% mean with a 6% standard deviation. And the exam question is, what's the z-score for an outcome of 22%? So it didn't quite make it, it's a positive return, yeah, but it didn't make it a full standard deviation above the mean. That would be 24, and we have 22%. So we take the mean of 18 from the outcome we're evaluating, 22. So we have 4 divided by 6. So the z-score is 0.6667. I don't know if they would round that, probably would. But it's a positive direction, but didn't quite make one full standard deviation. So I hope this one just, because I've had some students come back to me and say, yeah, I had no idea what that z-score stuff was. So I just guessed. You don't need to guess. This is easy stuff right here. Now you might have to calculate standard deviation, but the good news is it will not be 12 years of returns. Absolutely not. There's just not time to do that long of a calculation for the exam. You might see a question where you have 3 or 4 returns that you're going to measure. One way that's more time consuming that's in the book is this first one, where you take the difference and square it between the average return and the actual return, and then add them all up at the bottom, and then take it to a different power. So it's just not, this one just takes too long, but it just shows you some of the background with it. The one you're going to use if you run into this one is a quickie shortcut using your sigma register on the financial calculator, which, if you didn't know what the title of it was, it's the key that is located on the 3rd row from the top. This is the 10B2 or 2 plus. Second key from the right. That's the Greek symbol sigma, and the register just means it's a place to store stuff, to add stuff. So you will just put in the returns that you're given. You see, if you look back up to the first example, we had 13.5%, then 12, then 5, then -2, then 7, and so forth. So those values, forgetting not to change the symbol on the negative, I think we just had one negative return, didn't we? Yeah. So don't make that mistake with the 2. Make sure you change it to a negative. You enter those values and then simply press Shift SX SY. and that key is the shift function of the number 8 key on the calculator. And we come up with 12.29375, which is exactly what we would get in that very long method at the top. Now, the note box there on the left, usually the returns will be given to you and it'll have a percent sign, 13%, 12%. Now, you can use whole numbers as the example does, or you could enter like the 13.5% return as 0.135. The only caveat here is make sure you're consistent. Make sure you do it the same way, because I've had some students over the years that when they send me their input, some of the values were whole numbers and then some of them, for whatever reason, were input as decimals. So just be really, really careful with that. But rest assured, it won't be 12 values that you need to enter and deal with. All right, so we went through the curve. Next subject, the efficient frontier. And this would be one of those things. One of the reasons I picked this for the session is it's just not stuff we talk about every day, is it? It's not that we have a lot of practical experience with. But yet, this is one that, you know, there are multiple questions in the question pool about the efficient frontier. And often it's tested with a graph like this, with the plottings of different outcomes, and you know, you're asked various questions about that. So the question base is really in the plotting here, which of these are simply attainable at all, which are not attainable, and which are most attainable, and which is the efficient. What we're looking for is the most efficient portfolio, and what we're looking for are the values that plot right on that curve. That is the efficient frontier. That's what is represented by that curve, and we want to get our selections right on or as close as possible to that line. So if the question is simply which of these is attainable, well, it's everything under the line, under the curve. It's all attainable, but it's not all efficient. A and B, the plottings for A and B would be both attainable and are equally efficient. They are the highest return for a given level of risk. That's what the efficiency is about. So they, you know, A has the most efficient return at the lower end of the risk spectrum, and B has a higher return but also some higher risk. But among all the other plottings, they are the most efficient. The question could be about C. What's represented there? Well, C is very attainable, but it's not efficient at all. Why? Because for the risk level, if you just follow that line from C up to B for the same amount of risk, there are quite a few offerings that have a much higher return attached to them. So we would pick B over C, but C is absolutely attainable. Another question in the pool is about what is not unattainable. That's an easy one too. It's anything above that line, above that efficient frontier. It's not attainable. But that's 3 different question forms that you could see just about this, even if it were just a picture. And that one is showing up a lot. It's just a picture, and then they ask you questions about A, B, C, and D. All right, and here are just the basic rules. If you're being asked to pick one over the other based on what you see in the graph, here are your basic rules. Pretty intuitive though, don't you think? For any 2 risky assets with the same expected return, pick the one with the lower risk. For any 2 with the same risk, choose the one with the higher expected return. That's where we would pick B over C in that graph. And then in comparing two beside each other. If you have one with higher risk and higher return and lower risk, those would be our selections as well. But usually the testing, if they go this way, is A and B. You know, which of these two, from these two, would you pick? All right, so send me a note if you have a question on that. Another one is the stuff that we don't work with every day or think about every day, and that's this efficient market hypothesis, EMH it might be referred to. So one of the pool questions is that first point, that first highlight. What is it? What does it try to tell us? And what the EMH suggests is that investors just are not able to outperform the market on a consistent basis without accepting additional risk. And the word they use, and this has actually been in the exam, down there to number 2, part of that same question that could be one of the answer choices. Day-to-day price changes follow a random walk pattern. It's just it's not all that predictable. It's just random. The word random is what you would be looking for in that answer choice. So there's 2 different questions around that same just concept. What's the concept behind it? So to get deeper with EMH, we need to understand there are 3 forms in EMH: weak, semi-strong, and strong. And when you start taking this apart, it's easy to get confused, I think, but not if you break it down into real simple information. What we're talking about in these forms is what information, if you subscribe to weak, semi-strong, or strong, what information do you assume is already incorporated into today's price of that security? And the 3 variables we're looking at, the 3 types of information we're looking at, is technical analysis, fundamental analysis, and insider information. Those are the only 3 things that are worked with in these EMH hypotheses, right? So with the weak form, subscribers of that feel that all technical analysis is already in that price today. And this gets into price studies, and you see a lot of this, the charting and studying historical prices to predict future patterns or cycles. And the weak form just suggests, hey, it's already in there. That's already been considered. It's in today's price. So doing more of that may not lead to superior outcomes. But subscribers to the weak form do believe that if they had more and better fundamental analysis or insider information, that they could achieve superior returns. And the fundamental analysis, really spilling down to the next page, is a definition there. This is the stuff about the company itself, the financial statements or the industry in which the company is, or the current economic outlook. What we don't see here is things about price, historical pricing. That's the technical piece. But the weak forms say, hey, give me some good fundamental analysis and I could do superior returns or some insider information. So what we're looking at here is what's already incorporated. So the next one is the semi-strong. And these folks believe, or this theory maintains, that not only the technical analysis is in today's price, but so is the fundamental analysis. That's in there too. So I can't get any more, study any more of that and achieve superior returns. The semi-strong form states that, however, if there is insider information available, they could possibly achieve superior returns. But that's it. That's the only thing missing in the semi-strong. And then the strong form just says all three of those things are already in there. Not only does today's price reflect technical and fundamental analysis, it also incorporates any kind of insider information. So it's these folks that really are most closely aligned with EMH in that they're just saying it's all out there, it's a random walk, and there's none of those three forms of information is going to help me achieve superior returns. So it might be, the question could be structured in a way where they describe what the client believes in. And what you're trying to pick off is what things are technical, what things are fundamental. Do they mention inside information? That's how you narrow your choices to what do they subscribe to. Is it weak, semi-strong, or strong? So don't shy away from these questions either. If you can just remember the weak, semi-strong, and strong, and the three forms of information, you're on your way to getting these right as well. And I think you could see, I think you could see one that's the graph, and you could see another one in this area on just these three forms and remembering what information is incorporated. All right, changing topics again. The alphabet soup, you'll hear me say that again about trust funds in the estate session, but bonds kind of have an alphabet soup attached to them as well. So you will have some bond calculations most likely from any of those different kind of measurements you can have, but most likely, and we'll talk about this in a moment, it's going to be what would the price change be given a move in rates one way or the other. That's the most likely calculation you might do here with bonds. But make sure you give this section a good look, because it is really, really probable that you're going to see something. So here, here they're asking you to come up with a present value given a move in the rates. So in this setup, in this example, you would never use that long formula. You're going to use the shortcut. So they're telling us here that rates are moving on this similar investment to 10%, and we're sitting on a bond that has an 8% coupon. Most of these calculations you would want to set up in a semi-annual manner, even a zero coupon just for consistency's sake. But I doubt often or ever would it lead you to the wrong answer choice if you happen to run it with just annual coupon and periods instead of semi-annual. But just if you can get in the habit, do them on semi-annual. And that's what this calculation has done. So the most confusing thing we see in questions from this is remembering what values will change and what won't. So in these kind of calculations, remember that par value, which was our future value, and these are almost always at $1,000. That's not going to change. No matter what's happening with rates in the market, that's going to stay at 1,000. So will the coupon. And so the 40 here in the payment entry, that represents coupon payment of $40 twice a year, 8% of 1,000, right? And then we break down where the rate is moving. The I factor, the interest per year factor, that's just the 10 divided by 2. So we're changing that to 5. And the end value here in this example was 6. So we come up with then $949.24. But as I mentioned earlier, you could have already eliminated the answer choices that were 1,000 or more, because we're in an environment here in this example where the market rate has gone up. And what does that mean? Well, that translates into with this bond with an 8% coupon, it's going to be below 1,000. To compete with those 10 percenters, this one needs to sell at a discount in the marketplace to compete. So just remember, and I'm sure that's something so basic that you all remember, but you know, it bears repeating in a session like this. That's how you're going to take out. That's how you're going to take out two answer choices right away. And I stopped on another one here, and it ends up being you know, a discount scenario, but just seeing a present value of 750. What's that indicate? Well, that deep of a discount is going to mean that rates have gone up quite a bit in the marketplace, and this thing's going to have to be deeply discounted to compete. So there could be a conceptual question like that, not doing the math, but just saying, here's what's happened, and give you the values and say, what does that indicate? Well, it just indicates the new stuff is at a lot higher rate than what they're sitting on currently. Yield to call, another easy one if you know the basic structure of dropping in these values. But with the yield to call, remember the future value figure is going to be with that premium. So it's callable at 1050 here. That becomes the future value piece. And that's different enough because in all the other ones, right, it's not going to move off of 1,000. But when we get into yield to call, we need to incorporate the premium. And in our little narrative here, it says it was 105%, callable at 105%. And so that took us to the 1050. The other variable to watch out for in these is what's that period? What is the call period? And this one was callable in 5 years. So our N factor becomes the 5 times 2, 10. Those are the only mistakes I see people making in this particular kind of practice question. So again, just an alert, be alert, and it's another RTFQ, isn't it? Are they asking for, is there a call here or not? And so we always have to be reading carefully. There's just that reference to bond prices move inversely with changes in interest rates. The other good conceptual questions in the pool involving the term of a bond and price volatility is just to keep this handful of things, you just keep them in mind, that the term of the bond, the longer the bond, the more the price would be subject to fluctuating. There's just more time in which to do that. And then they give the example in point 2 that a 30-year Treasury bond will be more price volatile than a 5-year Treasury note. So longer means more fluctuation. The same goes with coupon rate and price volatility. The higher the coupon rate, the more stable it will be with fluctuations, and that makes sense of just how high would high go. Whereas if we had a 0 or a lower coupon, it's going to be a little more volatile. So there's 3 or 4 different questions that can source just from that one little section, just knowing the relationship up or down and volatility. Now I borrowed a page. You'll see this one again in the bond section of Live Review. This is out of the Live Review binder. And again, that section has some more numbers, and the same example, I think even that was taken from the book. But what I like is this, I call it the teeter-totter, the little graph that shows the relationship. So on the left, we have prices, premium at par, at premium, or a discount, and what's happening in the market. Then one variable is the coupon, then the current yield, the yield to maturity, and the yield to call. And this just depicts nicely the relationship with movement. If the bond is trading at a premium, we follow that teeter-totter down the line, and we see that the first stop it makes is the coupon. That's going to stay the same, right? If we travel further down that teeter-totter, right below the coupon is the line for current yield. Moving on, the next stop is the yield to maturity, then yield to call. So when it's trading at a premium, the coupon will be greater than the current yield and the yield to maturity and the yield to call. The current yield will be higher than the yield to maturity and the yield to call. So that's the relationship. Just imagine the line based on at a premium, par, or discount. Then how does it affect these three measurements? So again, this is one that would not involve any numbers. It's just, what does it mean? What would be the relationship of the current yield to the coupon if a bond is trading at a premium? Well, coupon's going to be higher than the current yield. Now you can prove that by doing some math alongside of it, but if you just think of the teeter-totter, you're going to be fine with this. At par, straight line, right? The coupon is equal to the current yield, equal to the yield to maturity, equal to the yield to call. And then inversely, writing the line of the discount, in that situation, the coupon will be lower than the current yield, the yield to maturity, and the yield to call, and so forth. So that's a really good exam question to just test it conceptually. And I think this is a great way to think about it. All right. I think this might be the last thing I have for you in this particular session. Margin. We get a fair amount of questions about margin and how to do those calculations. And from your studies, we're talking about a borrowing element in the purchase of the securities. And these will be at 50%. The questions, the initial margin is 50%. And then the second number we're looking for is the maintenance margin. And that's where a lot of these questions go, is you have to apply that math. And we're going to work off of a 35% maintenance margin. If you see reference to debit, the debit balance, as you'll see in the example, we're talking about the loan amount. And these questions will not be complex, involving multiple purchases. It's just going to be one. It'll be like you see in the example here. It's one thing, one time, and the two testing ways it'll come out of. So let's look at the examples, and I've added a piece that I like from course 103. So one testing question is, at what price would there be a margin call? And again, it's a single security, one-time purchase. So in the example that's in book 3, under number 4 there, the formula for determining it equals the debit balance divided by 1 minus the maintenance margin. So how much is the loan? And you see that in the example we had an initial margin amount of 50%, right? And that price was $25. So our debit balance in that formula per share is $12.50 divided by 1 minus the 35%, so it's 0.65. And that comes out to $19.23. So that's one way to do it. If putting that price in there initially is more confusing, you can go to the formula from course 103, and I just pasted that into the top of that page. And that one for some students is just easier to remember, that we take 1 minus the initial margin, 1 minus the maintenance margin, and then we apply that fraction to the purchase price. So you get the same math, because that one just becomes 0.5 divided by 0.65 times the $25. We get the same $19.23. That is an exam question. At what price will there be a margin call? So take your pick on which of those setups. They're essentially the same, but if one is easier to remember than the other, go with it. Then the other question that could be along these same lines is, you have to know, of course, when there could be a call, but then another question could be, well, how much are they going to need? Are they going to need to deposit? And now we're pulling in, a current price. And that'll be one of the flags. If you see margin information and they're giving you a current price, you may be about to be asked, well, how much do they need to deposit to bring it back up? So in this scenario, it's dropped. It started at 25, right? In the original story there is now at 15. And so we know there's going to be a call, right? Because it was 1923. So how much are they going to have to put in? Well, if you remember, the maintenance margin is 35%. So the required equity is 35% of that $15 current price. Now, sometimes questions will come in where they've placed $25 in as a stock price. This one's driven off of the current price. So the required equity is $5.25 a share. However, the loan amount didn't change, did it? They put up 50% of the loan amount is 50% of the $25 purchase price. So there's still $12.50 per share as the loan amount. So now when we subtract the loan amount from the current stock price, there's only $2.50 of equity. So that means they're $2.75 short. And all we're doing there is subtracting the current equity of $2.50 from the $5.25 required equity. So we have $2.75 difference. That could be the question. This is a big time RTFQ because it may be just what is the per share difference, or are they asking you to come up with the total dollar amount, in which case we would take the deficit and multiply it by the total number of shares. So that answer would be $4,400. Now, in this question, one of the answer choices could be $275. So we need, if they've said what are the total dollars, we've got to do that next step of math. So be careful when you see these margins. But this is how these two kind of shake down. But we get a lot of questions about it. I think that might be because computer software is doing all these calculations on a day-to-day basis, isn't it? But in CFP land, like so many things, we have to demonstrate knowledge by doing the calculation behind it. And that's where it catches even some of the best investment professionals, because it's just not stuff that you're doing on a day-to-day basis. All right, so I think that closes out the list that I wanted to talk about today. I hope you found some tips in there that can help you score a few more points. But like I said at the beginning, if you have something that I can help you with from today's session or any previous or upcoming session, send that in. I'll be glad to help you any way that I can. A lot of the stuff I can just answer, but if I need to get one of the content specialists involved at Kaplan, I will certainly do that. The content specialists tend to be the authors of the material that you're working with. So if we need their help, they're always there and willing to help us. So anyway, study on, my friends. Keep at it. It's a long race, but you absolutely will get there. Study with the confidence that you have the right partner in Kaplan and you have absolutely the right materials to get you there. You just need to do the work. But let us help you along the way, okay? Hope to see you in the next session. Take care. Bye now.